Hey, hey, it's Sunday morning. Happy February 18th. This is episode 7 from Your Mortgage Nerd. This is my Mortgage Nerd News rate update for all those who haven't tuned in before. Every week, it's super important to me that I bring the most recent updates about rates. And this year, especially the beginning of the year, it's been very important because rates, unfortunately, have been going up, up, up. So I will get right to it. Below here is the interest rate chart. This is what I use as a certified mortgage planner to follow the bond market. Those of you who've been following, you know that the mortgage rates are directly tied to how our bond market is performing. So let's take a look at this real quick. I'm going to actually pull it up on my program that I follow. So this here is the bond market chart. On the left-hand side, the vertical side, you've got the prices of the bonds, and on the horizontal side, you've got the interest rates. I don't know if you can see this, but it goes all the way back to November 20th. And then we've got the most recent Friday, which was February the 16th. So we've got some trend here where we can see that the bond prices have been going down pretty steadily since the end of December. At about the end of January, they've taken a big decrease here. Again, this is the price of bonds, but what we know is that mortgage rates are an inverse relationship with the bond prices. What that means is that when bond prices are down, interest rates go up. So that is why we've been seeing this increase in interest rates. Now, we did get a little bit of good news at the end of the day on Friday. Take a look at this. You'll see here that it's starting to curve up a little bit. Hopefully, we'll see the market sort of re-correct itself. It's not common that we just see it go down and down and down and down. If we were to look at this chart and looked at it from the max, we'll see here that you have a head and shoulders type trend constantly. Now, that doesn't mean that you don't see a dip in the rates, but you see a trend of it going back up and up and up. At some point in time, the $1 million question is just when will we see these interest rates correct itself? Now, that may mean we never see rates in the high threes again, but at some point in time, it's just not going to be common for it just to be a downward slope forever and ever and ever. So we'll be monitoring that for you. What I also wanted to point out, every single Thursday, I post the weekly mortgage market report, which is produced by the chief economist at Freddie Mac. So if you've seen my interest rate video on the homepage of my website, you see that all the banks get their money from Fannie and Freddie or Ginnie. And so what we see here is the most recent report as of February 15th shows that the banks are paying 4.38% to borrow money from Fannie and Freddie. What that means is they're not going to lend you the money at that same rate. They don't make any money that way, which is what I shop to find you the lowest rate. It's not necessarily the lowest rate. It's going to be the bank that's going to service your loan for the cheapest. So what I recently did this week to show proof to some of my clients that I'm not crazy and rates have actually gone up is I just pulled up wellsfargo.com and I wanted to see what rates they were advertising. You'll see here that their 30-year fixed rates are starting at 4.5%. You see that the VA rates are starting at 4.3. Take a look at this 5-year ARM. It's starting at 4.375. And one thing that we know is the advertising of their interest rates is always going to show best case scenario. If you read the fine print, it's going to tell you that there's 1 point of discount point, assuming 740 credit score, 20% down, all those kinds of things. So if they're advertising that these rates are where they're starting at, you can probably bet that the interest rate is going to be a little bit higher than these here because this is going to showcase best case scenario. So I wanted to get that out to you. Lastly, what I wanted to show you, and just keep in mind, I post this every single Thursday, the Freddie Mac report every Thursday, and this rate video every single Sunday. But keep in mind the interest rate and what it does to your mortgage payment. That's what I want to show you here. So this is based on a $300,000 purchase price, putting 5% down, and you'll see that each interest rate goes down by 0.125, which is how the rate market moves. What does that mean, dollars and cents, to your mortgage payment? Well, it means that one change in rate is about $21 a month for this particular example. So because rates have increased half a percentage point from the mid-January's, it means that you could be out of your price point because rates have increased. So if you're a real estate agent listening to this, if you have a house listed on the market and you receive a pre-qual letter that has a date prior to February 15th, you're going to want to call that lender and make sure that that client still qualifies with the increase of interest rates. It might mean that that client is out of their price range now. And for all my clients that are listening to this, you need to give me a call. We need to make sure that you are still shopping in the right price point, because this means that your payment might have increased $40 a month to get to that price point you were looking in. And with the increased rates, you might not qualify for that same point if you were shopping at your max. So this is very, very, very important. It is true. Rates have gone up. You need to reevaluate if you're still shopping in the right price point. And listing agents, you've got to call the lender and make sure that the buyer still qualifies, because we all know the domino effect of what happens if they don't. So thank you for tuning in for episode 7. Stay tuned next week for episode 8. I appreciate you guys watching. If you have any questions, go to my website on the homepage. It shows you how to email me, call me, text me, or book an appointment. Y'all take care.